is Jim Forsyth of Citizens for Sound Money. It's my pleasure today to have Nate Fisher on. Nate came to my attention when he wrote an article on 4D chess with Eric Sprott, and it really captured a lot of my thinking, which is, as gold and silver become money again, the people that are holding that will have power, and he's working to get as much of that as possible in the ground where it's cheapest. So really fantastic article, and welcome, Nate. Why don't you go ahead and introduce yourself?
Hi, my name is Nate Fisher. My background here for what we're doing is I'm a writer, a financial writer. I have an MBA and a master's in cybersecurity. So some of the stuff we're talking about here, I have a background in, although that's not my full-time job. So I'll touch on some of the what I'm going to be doing here today. It's called Classifying Asset Classes and Why It Matters. This is based off an article that you had read last week, and we chatted about it a little bit. So what I've done was I took that article and I expanded a little bit more into a slideshow. If you don't mind, I'm going to go ahead and start the screen share here. Okay, I'm going to start off here with Article 1, Section 10 provides that no state shall make anything but gold and silver coin a tender in payment of debts. And that's in our U.S. Constitution here. So a lot of newer people that come into this, I don't know about you, Jim, but I get emails all the time from newer investors. Where do I start? Where do I even find silver at? And a lot of people don't even realize that our Constitution actually states that gold and silver should be the only thing that's money. Now, we all know that that's devolved over the last 100 years or so, especially over the last 50 since we went off the gold standard. But I think it's important to have this as a starting place for what we're going to be going through.
Yeah, and
so go ahead.
And that was due to their experience with the continental dollar, where they were printing more paper than gold and silver, and so they wanted to make sure that that didn't happen again.
Well, as Mike Maloney, a lot of the knowledge I started off with was from Mike Maloney. He goes through a great history of gold and silver throughout the years, and it basically was mentioned that our forefathers had learned a lot of this history that we don't learn anymore in our books. As I mentioned, I went through an MBA, and in none of those textbooks do they ever mention anything about gold or silver. So I think it's important we keep this conversation going to a lot of the newer people that are joining our movement every single day. So we talked beforehand a little bit. I said, hey, at any given point in time, you see something on here, just jump right in. So we're hoping to have a conversation here today. If there's something that steps out, and we're just going to kind of have a back and forth here. So starting off with some of the big picture objectives, I wanted to discuss asset classes as if we were like in a high school biology class, and I want to describe the attributes. I'm going to go away a little bit from the traditional, divisibility, fungibility. I'm going to go away from a little bit of some of those more modern definitions, so we can discuss the properties of asset classes. I will also want to talk a little bit about the risk on and risk off and how this affects these different asset classes. Many of you have been in the industry for 20 or 30 years, can probably skip through a lot of this stuff, but a lot of the newer people, they want to jump right into and just put everything they have into gold or silver, and that's not what we're trying to get at here. We'll kind of go through a sliding scale of why we would do this and at what times we would do this. Next, we would kind of understand how some of these different asset classes are used to hedge against one another to preserve your wealth. Mike Maloney talks about in his wealth cycles. He talks about gold to Dow and gold to real estate ratios and all those other types of things. So that was kind of where the genesis of some of this started. And then I expanded upon this. I just went crazy with it. So you can see some inspiration from that in this, and also understand how to play speculations and why this matters to you. I think right now there's a misunderstanding of how certain things are classified today. I'm going to go through the different things and how they're classified and why that matters. But the word speculation, I'm going to dive into a lot throughout this presentation here. So the audience here, I want to go through some generalists. I know a lot of people are coming into Jim's realm of the world with Citizens for Sound Money. And I think it's very important to understand a background as to why you're even involved with this and when you should be involved with it. Looking for some newer investors, like I mentioned, I have a lot of people that are emailing me every single day about this. And I think I want to give them a good starting point as to where to reference, because you're not going to be in gold and silver everything for 20 or 30 years because it's a cyclical type of investment. The crypto people that are interested in sound money and preserving their gains, I know a lot of you have come into the crypto realm because you've understood that fiat currency is a problem. And I think it's very important for you to kind of understand how you've had such great gains, and now you would want to preserve them. And lastly, some of the seasoned investors out there might find another way of looking at this. You've probably been doing something for 20 or 30 years. You're set in your ways. I get it, but there might be another way of looking at this. You've not looked at this before. So I know in my field of expertise, every single day I love learning new things. So I'm hoping that for anyone that's watching this, you can kind of get something from this. So the big picture here, part one, I want to classify the asset classes. And why does this matter? So understanding financial energy and where it lives and how to store it. I know Maloney and some others have talked about financial energy, and the big thing that they kind of discuss is more or less converting mechanical energy to like money. And I kind of go the reverse with this. I look at gold as the center of everything, and that's how you're going to be measuring your financial energy. I'm not going to get into that here. I have a lot of articles on that, but there's financial energy that's around. How do you capture it? How do you grow it? How do you hold on to it? So you also should understand that asset classes do different things. And if you understand these characteristics, it will help you decide how much you should allocate to each one of these asset classes, when you should do it, why you should do it. And then also you have to understand each asset class has risks associated with it. So you may have loss or gain of financial energy within these things. So if you put things in the wrong asset class at the wrong time, you can lose pretty much all of your money. Now, look back at 1929, the crash. All these people were throwing all their money into these speculative stocks, and they lost everything during the Great Depression. Now, the next step here, it talks about diversification of financial energy, how it can protect your wealth. Now, if you were speculating in 1929 and you had a good portion of your portfolio into gold, you may have been okay, because as your stocks collapsed, your gold value would have gone up. And last, if you understand what is in what different classes, then it actually helps you hedge accordingly against counter classes. So what this looks like, big picture. Remember, I said Maloney talked about gold and Dow and real estate. I kind of talked a little bit slightly different. Instead of gold, I talk about money. And the money aspects here, it's consuming versus storage, business is growth versus contraction, and property here is utility versus speculation. I'm going to go into more of those definitions in a little bit, but if you're looking at this thing here, you see those red squiggly lines, and it goes over currency. Now, those red squiggly lines are kind of like your power lines right now. And you think about it like with Ohm's law, and you're sending power over copper, and the greater distance you have, the more heat that's lost. Well, the same concept you can have when you're converting things to currency. Think about it right now. We have 7% inflation every year. So the spending power of your currency erodes over time when it's stored in this. So what I'm trying to do here is to show you that a lot of people can kind of go in and out of these different classes, and they use currency, but they're not going to hold currency forever. It's probably a really bad idea in a high inflationary environment. So with the asset class of money, I took this picture from one of my writings. Basically in this, it's consuming versus storing, risk of losses with consumption. You'll see a picture in the next slide that kind of goes through some of that. But like I mentioned, I'm kind of using an old school definition of money here. I'm not going into the whole concept of fungibility and divisibility. What I'm looking at is just consider you're in Puerto Rico a couple of years ago during a hurricane and the grid goes down. Look around your house. What is money and what is not? And that's kind of where I'm looking at is if you're in, Venezuela, if you're in Turkey, if you're in some of these, in Argentina, some of these areas of high inflation, you now have to understand what you have that you can use as currency, what's money, what you can use to buy other things. So I put these in two broad categories of barter goods, where when I saw kinds of problems that were happening with the repo market in September of 2019 or so, I think I started to freak out, and I started storing all kinds of like canned goods. I got like quarter cows in a stand-up freeze in the basement. So
You know
these
what?
things, go
You know, it's
ahead.
funny. I tried to do the same. I tried to get a quarter or half cow, but we didn't have a big freezer. So I tried to go get a freezer, and you couldn't get
Yeah, that
them.
it was about a year ago. We were having months delays on even getting freezers.
Yeah.
And it just went to show you, because a lot of people were trying to store at the exact same time. People were running into issues where they wanted to go to the grocery store and store as much as they could. And you think about it, I'll show a little bit more in the next slide, but the other categories, raw materials here. Now, if you really think about it, raw materials are things that make other things. So I kind of use that in a broad sense of money category, because what you end up looking at the very bottom here is you have things like gold and silver. If you look at this, you can see that the gold and silver last a lot longer than anything else on here. At the top, you have fresh food. You may have chicken in your refrigerator and the power goes out. Well, how much is that chicken going to be worth in 3 days? It's
Right.
not going to be worth anything. So the concept here was with money. When you're putting financial energy into this class, you're going to probably be consuming things with like foods, or storing things. You might have firewood that you store. You may have coffee, salts, sugars, these types of things that you have around your house, that if there is some sort of grid down situation, these things actually, in a sense, become money. Now, right away, gold and silver won't be money. They talk about like, yeah, if there's a grid down situation, you can't eat silver. I get that. But what happens is silver can store that financial energy a lot longer than your chicken could. So the idea here is that in this type of class, broadly speaking, if you're putting financial energy into it, you're going to be either be eating it or consuming it, or you're going to be storing it. So with this, I mentioned I have the gold kind of as the center of the financial universe, if you will, and that's the title of what I have with the Palisades interview a couple of weeks ago. And the reason for that being was, if you just go back through a couple hundred years, you can see gold's relative value to other things is pretty much, it looks like a sine wave. Now, what that means is, in a broad sense, let's just take oil, for example, that's on this slide here. Now you can see it kind of looks a little bit like a sine wave. There's upper control limits, lower control limits, if you will, if this is statistical process control. But you have these relative values that go up and down. And you can tell that, you know what, if oil is priced very high in gold, people are going to produce more oil to capture those profits. Conversely, what happens is you now create a lot more supply. So when you have more supply, the value of it drops, and then you produce less of it. So this is what happens in pretty much every commodity with gold. Now, you have these crazy PhD guys out there that, that you have a PhD. I mean, your narrowness of your dissertation can be phenomenally narrow. And you will find there are people out there that may have written about gold and silver in 1645 to 1713 in England in a county. There are studies out there that, if you look at these papers, they're just out there, and they talk about relative values to money over the course of history. Now, somebody like Maloney gives you a lot of the cheat sheet for this, but the concept here is gold has relative value to pretty much all things: lumber, copper, cattle, like all these things, they have this relative value, and it's self-regulating. So if you look at it, silver has ties with gold and the gold to silver ratio, but silver has been tied with labor over the years. So you combine these two things, and they're pretty much a lot of the input costs that go into building and creating things. So the concept here is that gold is this proxy for pretty much all of money. So that's why Maloney and some others may just use gold as money for what they're doing here. So moving on to the next asset class, business. If you're taking your financial energy and you want to put it into a business, you're thinking like, okay, on the low end, I'm thinking I'm going to put it into bonds. It's a low yield, it's low risk. But in this section here, you're going to be putting it in with the hope of growing it. Okay, so you can see the pictures of the tomatoes over here. Pretty much like it's the financial energy you're putting into this, it's kind of like a seed. There's different levels of risk with this. And in this, like for instance, let's just say you have this financial energy, and I call them joules, if you will. And it's a mock one, like joules of energy. It's spelled differently.
I almost corrected your spelling and then I got to the next sentence.
Yeah. So like for argument's sake, let's just say a joule of energy, like maybe 1,000 joules is equal to 1 gram of gold. Okay. Now I use that joules because, maybe it's so many other ounces of silver that are equal to a joule of financial energy. So I just use this as an arbitrary object. And then, so you take this financial energy and you say, look, I'm going to take it out of storage and now I want to grow it. So what do you do? And the first thing you're doing is when you're putting it into business is you're putting it into a form of business process. Now this process has risks. Maybe it's a terrible process, but this process then unlocks other things. It unlocks your raw materials. You're going to buy it from, you're going to buy it from a supplier. You're going to pay your labor. And then you have the rents on the property that you're going to make this stuff in. And then at the very end, you have finished goods. So you're putting in 100 joules of energy and you want to get 200 joules out of it. Now, look at all these different areas that you can have risk. Maybe your supplier is late. Maybe they jack up the prices on you. Maybe your labor goes on strike. Maybe people quit on a Friday. And then maybe your plant burns down or something like that, or a local country seizes it. So there are risks involved with this. And with this, you take a look at, now, I think pretty much anybody that's involved with the stock market would understand this, that generally speaking, your risk of loss, the lower it is, the lower your reward for that investment is. So this is just generally speaking, on your lower risk side of things, you may have bonds. On the higher end risk of things, you may have things like sole proprietorships where you start a company. Great, I'm starting a company. Well, 90% of these things fail within 5 years. And generally speaking, you don't have any money, so you have high leverage. So you got a lot of risk with the amount of money that you've borrowed from the banks. So basically, when you're putting money into this type of asset class, you have a lot of potential reward, but it's based on the level of risk you want to take. So I'm going to get into those layers of risk a little bit later. But the next category here is property. And this is where I'm going to have some problems with some of your viewers in the comments here. But hear me out with this. I'm going through trying to look at this again, like we're in biology class, the kingdom, phylum, all that other fun stuff. That's about all I remember of biology, but the concept is you're trying to look at properties and traits of things and trying to determine approximately where it lies. So in this, with property, I kind of put this category as utility versus speculation. With property, you have different degrees of ownership. Like you may have a baseball mitt you throw in your closet. The second you buy it, it's $100 baseball mitt. The second you buy it, you try to sell it at a yard sale, you get $5 for it. So you have a ridiculously low speculation value with it, but you may have a high degree of utility in using it. Likewise, you may speculate on, beachfront property where you don't actually use it, but it's a higher speculative value. So you're looking for upside growth there with your property. So there's a range here that you can look at this. And basically you have a risk of loss of utility from high to low, if you're looking from the cryptocurrency down to the baseball gloves. But your reward for your investment, your speculative value increases the lower you go on this. So the bottom part here, I'll talk more about in a few minutes, but the cryptocurrency I placed here, again, here's where some hate mail is, but we're all going to be friends here and I'm going to explain why. So up on the top here, you're talking about your baseball gloves, again, high value of utility, but your speculative value, you lose almost all value. Think about when you're buying your appliances, your furniture. This stuff costs you thousands of dollars. You can't pay somebody to take it from you on eBay. But then as you start moving up there, you got things like cars and houses and RVs. Now all of a sudden you have a title to something. Now all of a sudden you have utility with it, but you also potentially have decent resale. So as these things go up, you have your utility of something go up, but then your speculative value go down, and vice versa. So that's kind of the broad sense of the asset class of properties. So, so here we go into what I was looking at, again, the biology classification of cryptocurrency. So I wanted to look at this in two aspects, currency and storage of wealth. Now, if you look at it at currency, so the cryptocurrency, you can see it like the cash if it's widely adopted. And this is where a lot of the crypto people talk about the network, because if it's like Visa and it's accepted everywhere, then it's universal and it's used as a currency. So I'm saying that right now, it's a speculation that it is going to be currency. So that's where I'm going at with this. So you're looking at some of the other aspects of this. You talk about stable coins. Well, you start looking at like a Tether, where they may be having some problems with regulatory. Now, eventually it was sold to everyone that it's like 100% cash or something like that. And it turns out it's 90% commercial, 97% commercial paper. And I think it's based out of Hong Kong. Don't quote me on that. But with that, then you wonder who's owning that commercial paper. Does it have any kind of exposure to Evergrande? So you start to wonder what's under the hood of some of these things, and you start to see where the risk is, where the speculation is. You see a lot of governments banning these cryptocurrencies. Then you have the US wants to create their own Fed coin. Now, right now they allow certain things, but maybe a couple of years from now they won't. Things like Tether. I know there's some guys on Twitter and stuff that cover the Tether prints, where these things can kind of print themselves into infinity. And now you have a dilutive effect with things. If that paper that's backing it is some sort of leveraged bet, and it's a fractional reserve where maybe it's like 1 out of every $30 is actually in US dollars. What happens when there's a rush to the door in a risk off event and things happen and people want to go from Tether to US dollars? What happens in that moment when then they got to try to liquidate all of that commercial paper? What's going to happen to the interest rates of all of those things? So there's risk there with that. Bitcoin at the very bottom here, I have my disagreements with Michael Saylor, MIT guy, obviously very brilliant. He also says that Bitcoin is not a cryptocurrency. He calls it a crypto asset. So the people that want to jump on me for this, take that up with Michael Saylor for a moment. And it's not a particularly good currency, simply put, because there's high transaction fees and it takes a while for things to get done. So I'm looking at things right now with your cryptocurrency. It's a speculation that it will be widely used. Okay, so that's how I'm looking at it in that extent. And I'll compare it to the beachfront property in a second. But
so wait, go back to that slide for a second. So
yeah.
just some comments. Yes, on that first bullet point, I guess I would just make the point that it's a spectrum, right? There are places that are accepting Bitcoin as payment.
We were talking about this beforehand. I think there's Litecoin is being used with Visa right now.
Right.
Obviously you go to some coin dealers online and they're accepting Bitcoin and Ethereum. But then there's 9,600 or so, or 10,000 different types of cryptos.
Right.
I mean, if you're a merchant, how many of these are you expected to support 5 years from now?
Yeah. So I just would, make the point that, yeah, I totally agree with you in terms of you're speculating that it's going to see widespread use.
And it could,
but a lot
very
of
much could.
But it already is seeing some use, and so the speculation is really that use is going to grow, right?
Absolutely.
As long as that use is growing, the network's getting stronger, and more people are using it, and you're making money, so to speak.
Yeah, I think it was. Go ahead.
Yeah, and just the last point on the last bullet. People would argue that the Lightning Network is the solution to that. I totally agree that Bitcoin by itself, has a high transaction fee because of the cost of mining. and it's relatively slow compared to more modern cryptocurrencies. But, whenever I say that, people come back with the Lightning Network. So
Yeah, well, you know what? A very interesting. I think I went into this a little bit further down, but basically, one of the issues you also have with Bitcoin as a currency is that it's a highly deflationary type of asset, and that's one of the attractiveness of it. Now, if you look at the flip side, if you think about the U.S. dollar in high levels of inflation, and they're printing the dollars, you're trying to get out of the dollars as quickly as you can because you know that the next day the value is going down. However, if your currency is highly deflationary and you think the value of this currency is going to go up astronomically the next day, you're not going to spend it. So it in a weird sense, it is not a good currency because no one's going to want to spend it. And that the I guess what you can consider the velocity of money, if you will, with Bitcoin would slow tremendously because no one would want to spend it. They want to hoard it because it potentially is worth more the next day because it's deflationary.
yeah, I have mixed
That's something
feelings.
that'll bake your noodle.
Yeah, no, I have mixed feelings about that because that's one of the arguments people use against gold is to say, gold is essentially slightly deflationary, and that's why we can't use it as money. And I think that's BS. But at the same time, gold does have the mechanism, and silver, where if monetary demand of it increases or population increases and the price starts to rise higher than the cost, then there is incentive to go mine for gold and silver and get it out of the ground.
Absolutely.
And I think that market mechanism of tying, the price of gold and silver and other goods back to an asset that, can be mined as demand increases is a valuable thing. But yeah, so
And that's where I was getting at with the relative values of things.
yeah,
Because what happens is if you start to see things that are, things are very expensive in gold or whatever, maybe it has you go out and mine more gold. Now, remember, I just said Bitcoin is deflationary, cash is inflationary. And what's interesting with gold, I read this, somebody correct me in the comments if I'm wrong here, but I've read that gold approximately inflates at the same rate of inflation as us. So like for our population, it's about 1.25%. So therefore gold is neither inflationary nor deflationary, and it's got historical value relative to other things. So, what is it? An ounce of gold is a fine suit, and it's been like that way for hundreds of years, regardless of the nominal value.
Yeah, I've heard that as well, that it grows roughly at the rate of population growth. It still winds up in essence being deflationary because of productivity improvements, but that's a good thing. Your money should buy more and more over time. Like you could buy a Roman toga or you could buy a nice Italian suit now, but the Italian suit is obviously much, fancier and well constructed than the toga.
Well, part of that is if you take a look at commodities, and essentially when you look at long-term charts of the production of commodities, you start to see that the cost of producing them go down because of technologies, efficiencies, and all that other kind of stuff. So yes, potentially the value of that suit, it costs less to produce it. So that's somewhat deflationary. So then the gold actually doesn't rise in price. It's still relative value to that. So there is some deflationary aspects to that. Yes. So moving on here, if you don't mind. So store of wealth. Okay. So this is the big selling thing that you hear with Bitcoin. So I just want to look at the properties of this. So if Bitcoin and some others are considered hard assets in a sense, because they have a finite supply, we just talked about that. Now gold has a relationship, like I said, of a value to all things, but Bitcoin doesn't have that established history of a value. So you don't know, is it Bitcoin related to a bushel of corn, a bushel of wheat? There's no relative value established. The only real values that we have Bitcoin in right now is the US dollar. And as we know, it's a floating currency that goes up and down according to a basket of other goods. So yeah, Bitcoin would be relative in your own currency or whatever. But the concept is that Bitcoin has no relative value to anything else. So how is it a store of wealth at this moment? So that's just one test I had here, but I think it's an incredibly good store of wealth in one situation. Okay. Now, I was wrapping my mind around how and why I would use a Bitcoin a couple years ago. And I thought of it like, let's just say you're in Turkey and you have a high level of inflation and your lira is going down in value every year. And you say, you know what, maybe the government controls are in such a way that you want to flee the country. Okay. Well, all these countries have controls that you just can't walk onto a plane with $100,000 in gold. You can't just walk, you can't strap $200,000 of dollars around your chest and walk into a plane. How do you get that money? Now, like China and stuff, they have capital controls where you just can't export money out of China. So how do you get that money out of the system? So if I'm leaving, Turkey on a plane and I want to fly to New York, for argument's sake, I can put that into a Bitcoin or any kind of cryptocurrency I want. And then when I land in New York, I can access it on an exchange, and immediately I've traveled with my money outside of the system. I think it's an incredibly good value for that. Now, I'll talk a little bit more about Kinesis down the road. We've also found that Kinesis can do the same thing where you can transport your gold on a crypto sense. But I don't want to get into that too much here. So furthermore, if you're looking at the properties, you can see what you want to do with a store of wealth is you want to preserve your wealth. And you have to ask yourself this honest question right now. Did you get into Dogecoin to preserve your wealth? Or did you get into Dogecoin to get a 10x in the next week? That's an honest question that you should be asking yourself. If you've bought Dogecoin because you thought you were going to preserve $5,000 of spending power throughout the next 100 years, you're probably lying to yourself. It's the same concept with Bitcoin. If you watch any Bitcoin interview, Bitcoin to $1 million, they're not talking about preserving your wealth. So there is some aspects where it could be, and I can speculate that 5 years or 10 years or 15 years from now, this could be a good preservation of wealth. But look at the next two. It's never seen a recession. No cryptocurrency has ever seen a recession. So if you're like 31 years or younger right now, you've never seen a recession. And this is most of the people that are involved in cryptocurrency. It's never seen a recession. So you can theorize all you want that it's a hedge against the US dollar, it's a hedge against that. But the truth of the matter is there's no empirical data that supports that. It's all theory, which goes to the next state here, is that the next statement was Bitcoin, I think in 12 years has pulled back 90%. There's different reasons for that. And they talk about Bitcoin cycles, if you will. But the question here is, how good of a store of wealth is it if you put all your money into something and 3 weeks later, you've lost 90% of its value? So I don't think it's a particularly good store of wealth long-term. So I'm looking at the properties here, and this is where I came up with, I think it's beachfront property. And this is where people want to get mad at me, but it's a speculation for now. And in 5, 10, 15 years from now, your speculation could be 150% right, and you would be worth $1 billion. Great, that's awesome. But you have to understand what you're looking at right now is a speculation. And I wanted to compare this a little bit. So if you're looking at a beachfront property versus cryptocurrency, you're basically looking at a physical address versus a digital address. It's a space somewhere. And like your beachfront condo communities and your communities that pop up everywhere, the more of these communities that pop up and the more cryptocurrencies that pop up, it dilutes the amount of spending power that can go into any of these things. So you will see some of these things fail. You will probably see 95% of these things fail in the next year or two. The same thing with your beachfront communities. Only the best ones of these are going to survive. Both of these things kind of need endless promotion in order to keep fueling it. Because if you have a cryptocurrency like Dogecoin and you've held it for 6 months and it's gone nowhere, and you've seen this other coin that's gone up 3x in a week, you're taking it out of your Dogecoin and you're putting it into, your Inu Shibu or whatever the hell that's called. You're putting it into your other crypto. You're following the hype cycles. You're following the promotion. If your investment relies on Elon Musk tweeting on Saturday Night Live, that's not a store of wealth. That's kind of a promotion gimmick that you would think of with some sort of beachfront community. So with this next thing here, the greater fool theory, don't yell at me about the name of this. It's the concept of the value of this entity is only worth more if I can convince you that it's worth more. And I have to sell you this vision where Bitcoin's going to be $1 million. So buy my Bitcoin at 60,000. So you have to have that promotion, the greater fool theory. You have to have this constant feed of people coming in based on that vision. And like I said, I'm the beachfront property. You can buy it for $5,000, and 10 years later it could be worth $1 million. That's a great speculation. So I'm commending anyone right now that's made a fortune on your cryptos. You were a visionary. That's a great speculation. But what happens then is you may have risks ahead. Like for instance, the next one here, if you have this beachfront community, you can have your next town over. They don't want trucks coming through. Maybe they create ordinances that these big trucks can't come through. And now all of a sudden they can't develop the beachfront property. You bought this for $5,000 and now no one wants to buy it from you because they can't do anything with it. So you have legal, you have counterparty risks with this speculation that are legal. And then the last thing here is how many of these coins have we seen? What was that? The squid coin just popped up.
Yeah.
Squid coin popped up.
Squid game.
Bam, right down. Up and down to zero. Okay, so these things you speculate. They can go up. Bitcoin could be $1 million a couple years from now. I'm not here to argue that it will be. I don't know if it is or not. But if you understand that it's a speculation and you can classify it as such, now we can talk about what to do about it.
Is
Okay,
this quick comment on the greater full theory is depending on who's talking, that the difference between the greater full theory and promoting Bitcoin because you think it's going to be money and it should be money, is all goes down to intent, right? There's people that like Lawrence Lepard that talk about it. He's not in it for the greater full theory. He's trying to get more and more people to use it as a replacement to the dollar versus others may be doing it as the greater full theory, right?
I think the bigger picture with that is that I know 1 ounce of gold is worth a suit.
Right.
However, the only value that's associated with Bitcoin is what I can project the value is going to be in the future.
Right. It's a speculation on
It's a speculation.
on
So
it's the increasing use as money.
The greater fool theory gets people very upset with how it makes them sound like fools. And I don't want them to, I don't want to convey that in the least way. And I'll tell you here, I'm going to show you Bitcoin can be a great speculation. It's just, what do you do about it when you're up 600%?
Yeah.
So with this, we're going to talk a little bit now about risk on, risk off. We're going to talk a little bit more about hedging, but with risk on, you're thinking about, hey, in times of risk on, you're thinking that the stock market's going crazy, stonks go up, if you will. And with this, companies see all these people spending money and they want to expand their plants. They hire more people. They want to capture that market share. Gold doesn't have any yield at all. So they say, hey, my pet rock sitting over here isn't giving me anything. Why don't I sell some of this in order to, then turn around and buy stonks that go through the roof. So gold in this situation may get sold off. And likewise, you have low risk bonds here. Who wants to hold something that's yielding 1.5% per year when I can sell that and I can get 20% next week on an Amazon investment? So that's your risk on. And for the last 13 years or so, people have pretty much, that's all they've seen. That's all they've known is risk on. And part of this, the whole part of this presentation is to say that there might be a risk off time coming. And what do you do about it? So the risk off here, that's when you're going to start to see people taking profits. That's when you're going to start to see sales declining. Less companies are expanding. Interest rates are starting to go up. And now people are starting to worry about, hey, I just made 7 times my money in Bitcoin. I just made 10 times my money in Tesla. How do I keep this and prevent from going down with the stock market? Okay. So this is now the mindset where a lot of people started thinking, like myself a year or 2 ago, is I'm starting to plan for risk off. Now, I'm not going 100% in, and I'll explain, how this all works out. So overall, what we've been talking about here, understanding the risks here. Now, if you see the risk levels at the top are the lowest, at the very bottom, the risk levels are the highest. and look at the preservation potential. The top preserves your wealth. So the bottom part doesn't. Remember that beachfront community? I bought it for 5,000. It went up to 1 million, and then some ordinance came around and said trucks can't go over this, and all of a sudden I went down to zero. So when it's $1 million, why wouldn't I take some profits out? Why wouldn't I, if I think there's going to be, some legal problems coming, why wouldn't I like sell half my land or something? So you start to understand that the risks here, the lower the risks, the better the chance you have of preserving your wealth in a risk off situation. So with this, there's the concept of hedging. Now, I'm not going to get into this. I don't work for a hedge fund. I want to give some broad strokes here for the folks, and feel free to add to anything here, Jim, if I'm missing anything. But you just look up the definition of this. You just protect oneself against a loss on a bet or investment by making a balancing or compensating transactions. And the balancing here is why I figured it was very important to define asset classes, because you want to have these things balanced across different asset classes. So, just an example here, you might have a wheat producer that wants to produce 100,000 bushels. He'll hedge on the futures. If he produces more than 100,000, he loses on his futures bet. But maybe a flood comes through and wipes him out. He loses on the profit from the bushels, but he wins on his futures bet. So what you're doing is you're locking in that 100,000 or so production. So with that trade-off, you're capping your upside gains, but you're preventing against your downside risks. So one of the things with this is gold is kind of a hedge against US currency. Now, we've all seen that since 1913 or so, since the Fed came to be. I think the value of the US dollar, I think, has lost 97% of its value in gold. So we got 100 and some years of history that shows that gold has been a hedge against the currency printing. You can also see that gold is against a hedge against stock market doom. So you see that when wealthy people may have 1 or 2% of their holdings in gold or gold stocks, if you will. And then what happens is, again, with this hedge, if maybe their Tesla starts to go down because there's a risk off event that's happening, their gold value goes up. So they preserve what they have, and they don't put it all in Tesla. So with this, if you understand the risks associated with your financial energy, you can rebalance your portfolio to adjust for this. I wouldn't say you're going in every day and tinkering around, but if you're working with a financial advisor, you can broadly kind of put stuff into different asset classes. Now, some of the things that are the biggest determinants of this, just think about age, okay? You're 22 years old, you're living on your mom's couch, okay? You can go into business for yourself, and if you fail, you're still living on your mom's couch. You can put everything that you have into cryptocurrency at 22 or 23 years old. And if you lose it, so what? You got 45 years of earning potential.
Right.
So I'm going to kind of go through how people might look at this differently. And this is where I have a big disagreement with Michael Saylor. He basically, in that article, I basically pointed out that he was kind of like, hey, put everything you have into Bitcoin, no matter what. And I'm just kind of like, well, we might want to kind of just, tweak that thought a little bit. So with this, I would not want people to YOLO into anything. So with this, again, you have your speculation strategies. So I particularly love. Go ahead.
Quick comment. What you said about when you're young. I was taught the very opposite when I was young. It was put 10% of your income towards a nice, safe investment, and you'll be rich by the time you retire. That was BS, right? We had the .com bust and index funds and all this stuff. So now I find myself 10 years from retirement taking the risk that I should have taken when I was that young. When you're young, yeah, you have all those earning years ahead of you. Go for something you think's going to be 10x. If you lose, you'll learn from it, and then come back to it years later. But anyway, I just wanted to.
Yeah, when I was 23 years old, I actually worked for the Vanguard group of mutual funds. I was an IT contractor there, and you go and you fix people's computers and stuff, and you're sitting in the offices, and it was really cool because they got Wharton degrees on their walls and stuff, and you walk through it, and they tell you about the compounding interest, and you put so much money in, and you get your 8% return on your index funds and blah, blah, blah. But nowadays you can't really get those types of yields from things. I mean, maybe you can, but when you're 22, maybe you have a small portion that goes into that. And then over the time that compounds. But you're right, you know, I'm older on in life and I don't really have any kind of retirement fund. So I have to take a little bit more risks for certain things. I'll get into what my portfolio is below. But with this, like part of this, like I love speculation. Like I do, I love it. My choice for speculation is gold and silver miners, explorers, call options. I do take risks on things. Okay. So one of the theories that was taught to me when I first started doing this was, well, if you have a double on an explorer, take half off the table, just sell it right away, sell half, and then let the other half ride for free. On a third, just take a third off. On a triple, take a third off. On a you know, a 4x, take a quarter off, so on and so forth. Now, sometimes I've woken up and some of these explorers have been a 3x almost overnight. That's happened to me, and it's awesome. And then I sell 1/3 off, and then a couple of days later, these things crash back down. I'm like, wow, I got all my money back out, and now I can just ride the rest of this for free. So the concept here with this strategy is get your seed money out. So if you're in like a Dogecoin and you got in at 3 cents and it goes to 6 cents, sell half your Dogecoin, you take that off, and you can speculate in whatever you want. But now what you have for free. Instead of riding it all the way up to 81 and then back down to 5 or whatever it is, you lost a lot of those gains along the way. So with the high risk speculations, you want to try and capture some profits along the way. So like I said, you know, with beachfront property, you can run into a buzzsaw. There can be problems with mortgage rates, could go through the roof, and all of a sudden nobody wants to build a house. In the 90s, I don't know if you were involved with this with baseball cards. Everybody wanted to get in baseball cards. I was involved with that. And all these baseball card companies popped up everywhere. Then they printed these things to oblivion. The entire baseball card economy completely collapsed almost overnight. And then we talk also about the squid coin. The people that started it made millions of dollars. They got out of it real quick, you know. So with the speculation strategies in my article, there was a bunch of questions I had asked. I'm going to just kind of buzz through these. I don't have answers for these, but if you're speculating on any kind of crypto or explorer or beachfront property, these are the types of questions you should be probably asking yourself. Like, what part of your total holdings are you okay with going to zero? This keeps you from potentially taking all of your cash and putting it into one thing that's a high risk speculation, because if it goes to zero, you lost everything. What is your expected upside? Now, you can listen to the hype that, hey, it's going to go up 100x, but I mean, realistically, what is the realistic value of this thing going up? How comfortable are you holding it long time? I know with some of my explorers, there's one in particular I'm not going to mention, but this one explorer is going to be building a mine in 2025. Well, if I put all of my money into this, it could literally go nowhere for 4 years. And there's a lot of opportunity costs with other things going up. And then this thing may not end up getting built in 2025 and go to zero. So what is the time you want to hold this thing? Because the more time you're holding a high risk speculation, the greater chance you're going to lose out on that or other investment opportunities. What are your stop losses? If you're YOLOing into something and you have no stop losses set on something, that's a problem. So a lot of times with my call options, I'm guilty of seeing a 2 or 3% loss every day for weeks. And these things add up. And before you know it, you're down 50, 60, 70%, and you didn't even realize it. So do you have stop losses set on certain things? Are you riding it out to zero? What research have you done? Do you pay paid professionals? I would love to say I'm this genius mining stock guy. I'm not. I pay smart guys, and then I read their research and I digest it. And if a bunch of these guys are kind of saying the same thing, I have a higher degree of confidence in my speculation. Now, if you're just listening to one guy on YouTube that's saying this is going to the moon, you might want to try and get some other research. What do you personally know about the speculation? Like I mentioned, one of my master's degrees is cybersecurity. I probably know more than 99.9% of the people about the back end about how this stuff works. That being said, is my personal preference for speculations, you may like beachfront property. I might like the cabin by the lake. I don't like sand. Okay. So I have a choice for a different type of speculation. So those are the types of things you have to understand what your career background is, what particular aspect you may know about this. And what is your profit taking plan? Like I mentioned above, if you have a double, are you taking half off? Or are you letting it go up 10x and just, maybe it comes all the way back down? So part of the speculations are asking yourself some of these questions here, like, when are you actually taking profits? When is your entrance and exit plan? Are you actually buying in? I've heard some people say they're buying Bitcoin a little bit with each paycheck. Okay. So they're averaging their dollar cost in. That's great. They're not going $100,000 in tomorrow. I kind of like that. They're buying in a little bit of time. They like the coin, whether it goes up or down in value. How would you store these financial gains? And I'm going to talk about rebalancing your portfolio a couple slides down from here. But if you're up 10x on your Bitcoin, you might want to think about rebalancing some of this stuff. Also, is the market in an overall uptrend or downtrend? If you think that your crypto is going to withhold, the next recession or depression because someone told you, just consider you might want to hedge against that risk. You may be wrong. If you are wrong, there are counter assets that will go up when the stock market goes down. Another thing is a lot of people buy cryptos using leverage. A lot of people buy stocks using leverage, high risk things. If you're thinking there's a risk off environment coming, you might want to start to deleverage things. A lot of people may start to deleverage, which will actually you will start to see sales of things drive the prices of things down. And also, as me and Jim were just talking about, how's your retirement plan looking? You may have to risk more than someone else of your age because you didn't do things at 22. So I wanted you to visualize this. If you're 22, maybe you have half of your total assets. Maybe you're chasing Dogecoin. You got it at 3 cents. It went up to 81 cents. Great. Now it's down to 20. So the concept is you still may be up 6x, but when are you taking any of these profits off there? So 22-year-old may have a different portfolio look than a 45-year-old. And he may look a lot different than what a 65-year-old does. Somebody who's right next to retirement might be just trying to hold on to what he has. He has no interest in Bitcoin. So the Michael Saylors of the world that want the 65-year-old to sell everything and sell their businesses and borrow as much as they can to buy Bitcoin, that's not particularly a good strategy for a 65-year-old. So with that, let's just say you were a 22-year-old and over the course of a couple of years, you've gone 10x in your crypto. Well, now you have a wife. Now you have kids. Now you have responsibilities. And it should start to change how you change your portfolio. Now you should talk to a financial advisor and not listen to some crazy guy on YouTube, but this gives you a good idea of how someone would kind of rebalance some of this stuff. Maybe you sell out of a lot of your high risk cryptos and you buy a house. You put a down payment on a house with some of those profits. Okay. Maybe you buy a rental unit. Maybe you put a little bit into a coin collection or some high risk stocks or something. Maybe you put 5% into gold or silver and hedge against the worst because you think there's a risk off event coming. Now, I just turned 46 today. Happy birthday to me. So with that, me at 46 is a lot different than a 22-year-old or a 65-year-old. Now, somebody like me, half of my stuff is in the house I live in. I fix up my basement. I put money from my profits into fixing up my house. I invest in my house. 35% I added rentals to this thing here. So I own two houses that are rentals that are 3 rental units, and I have income from them. And that income from them, those profits are going to not only maintain those units and upgrade them, but some of those profits can get taken off to put into gold and silver and supplies above. Now, remember I said I feel that there's a higher probability of a risk off event happening. So I am way wild into gold and silver stocks and all that other fun stuff. But if you look at it in totality, it's only about 15% of my portfolio. Well, Nate, you're stupid. Nate, you're stupid. You put all this money into gold and it's gone down 30%. Look at oh my God, you're so stupid. Barrack has gone down. Newmont has gone down. Well, because it's only 15% of my portfolio, it was a hedge against a downside, and the downside didn't happen. Instead, what happened was the value of my house, value of my rentals, the value of my car all went sky high. So I had a great upside capture with that, and my gold and the gold stocks, they went down. So I preserved my wealth, and it was a hedge against something bad to happen. So if the market does turn south in the next couple of months, you know what's going to happen? My house value is going to start to go down. My property value is going to start to go down, and my gold and my stocks are going to start to go up. So the concept here is I balance that portfolio based off of my unique situation. Now I have 35% of my portfolio there into a riskier type of thing where you're talking about rentals. Where somebody like my peer, one of my buddies, he's had a 401k for the last 25 years working for Verizon. That guy's got a crazy 401k. He doesn't need to put stuff into rentals. He's going to be okay. So you have to determine your risk, your percentages, and it's different for everyone. But one of the big things with that was if you understand the asset classes, it helps you hedge accordingly. So Jim and I, we're both, disclaimer here, we're both heavily involved with Kinesis money in one way or the other. But I wanted to briefly talk about this as a cryptocurrency. It's called what we call as an asset-backed digital currency. So I put this in the category of gold, because if you're investing in Kinesis, you're buying grams of gold and you're buying ounces of silver. You're not buying it for that same speculative wear Lambo, with Dogecoin. You're buying gold and silver. So I have some stuff on here where, gold is backed by central banks. It's not really speculative value. It is a store of wealth. So this is potentially a hedge against your high risk, your high risk crypto assets. So if you want to look at this in a broader sense, 100 years ago, you took a $20 bill and there's a little orange thing on here, and you went to the bank and you slapped that down, and you got, and as Mike Maloney says, you got the ounce of gold back. Kinesis is the digital version of that. So you could take your Kinesis token to the exchange and you can get your gold and silver out. And I know, Jim, you can comment on this in a few minutes, but I know you had actually taken silver off the exchange. So the concept here is if you're somebody on the right-hand side here that you're involved with crypto, you have a tether, if you will, to the US dollars. And somebody's told me that Bitcoin kind of is like that anchor to other crypto assets. And I get that. But if we're going to a risk-off environment and you want to make some sort of shift, you can put these types of things up on the Kinesis exchange, and you can instantly start moving some of your stuff into gold and silver to de-risk some of your portfolio. So that's kind of what this looks like. You have your market pairs. You can buy and sell this stuff immediately. And I want to use this as a proxy for asset-backed digital currencies, because there are other things out there like Load and Cash. I just happen to be a member of this, so I took some screenshots and I'm familiar with this product. So I don't want to make this a commercial for it, but the concept here is that if people like crypto, here was the big thing. I know that Frank Giustra and Michael Saylor had this big debate. And the one thing I thought Giustra missed on was you have asset-backed digital currencies, where if you like crypto and you like the blockchain, you can salami slice gold into 100,000 portions and you can pay people with gold. Whereas Giustra kind of missed that point. You're not walking around with gold coins and silver coins in your pocket to pay for groceries. You could use a Kinesis on a card and essentially buy groceries or pay your friend in gold or silver. So, that's where, if you like your crypto and you like your crypto speculative side of things, that's a way that you can kind of lock in some of your profits. If you're 10x on Bitcoin, sell 1/5 of it. You take it and you put it into low risk bonds. You put it into gold. You put it into silver. Maybe gold and silver miners. Those types of things. Maybe energy companies, whatever. But some of the conclusions here. You have your own unique portfolio customized to you. You should talk to a financial advisor. They're probably going to laugh at you about gold and silver, and they're probably going to laugh at you about crypto. So be prepared to have somebody that wants to sell you their 10% or 20% per year safe portfolio, which again depends on your age and your situation. And you may have to, from time to time, rebalance your portfolio. If you wake up one day and your Bitcoin did go up 10x, and you're looking at your portfolio, oh my God, I did so good, but now you got to lock in some of those profits. You have to occasionally rebalance your portfolio. So, and lastly, I just wanted to make that point at Kinesis where you could easily, on risk on events, take your gold and then convert it to Bitcoin. On risk off events, take your Bitcoin, convert it to gold. So you got that arbitrage back and forth constantly. So you could potentially, instead of riding Bitcoin down 90% and riding it back up, when you're up 10x, take half off the table, put it in gold. And then when it goes down 90%, you can buy 2 or 3 times the amount of Bitcoins that you used to have. So with that, I think we've covered a lot of ground here. Do you have any kind of questions or follow-ups with this? I know I've gone on and on with this, and I love this type of thing. I write about this all the time. So I got a lot of this in my head, and someday I'm probably going to write a book about it if I can find the time for it. So.
No, this is great. And yeah, I sold a little Ethereum yesterday, so I could get some silver on Kinesis platform. You know, you can trade exchange pairs. But I had bought a bunch at $1,800 because we need Ethereum to transfer KBT, and I bought more than I needed. And when it hit 4,300, I sold a little bit.
You banked your profits.
Banked my profits. Yeah,
absolutely.
It's a good point that, you know, if people are right that Bitcoin becomes the new world reserve currency, right? It wouldn't take much Bitcoin in your portfolio to do really well, right? So you don't need a huge heavy weight, but it is certainly not a certainty, you know? And so I love the way you talk about this. Is like, if you look at anything, never give it 100% chance of happening. You know, nothing's 100%. And if it's not 100%, ask yourself, what if I'm wrong, and how can I protect myself against that? And
yeah, you may have like extremely wealthy people that might have 1 or 2% of their portfolio that's gold. But if you look at what happened in a situation where it's like 1929, you know, if you have all of your money in stocks and you have nothing in gold or silver, and something does happen where the stock market takes a really bad accident, you lose everything. And the concept of the gold or silver is a hedge against a lot of this doom. It's insurance. You don't have to be 50% gold or silver. The concept here, above all, was, hey, if you have a lot of profits on your awesome speculations, how do you store some of that for long periods of time? Because I think gold and silver are a much better store of wealth right now than a Bitcoin, because of obviously the characteristics that I mentioned, where, you know, you go back hundreds of years, 1 ounce of gold still buys what it did a couple hundred years ago. Oh, the big thing I like to talk about is silver. I use this thing. I can leave off with this, is that you have two dimes of silver from 1964 buys 1 gallon of gas. Okay, if you take those 2 same 1964 dimes and you take them to a cleaning shop today and you get the currency back for it, you can go buy 1 gallon of gas. Right. Guess what? In 100 years from now, those 2 silver dimes are going to buy a gallon of gas. Yeah. So you don't get into gold and silver you don't get in there to get stupid rich. That's what I play my miners for. Okay. Right. You get into gold and silver because it has a store of value that is worth certain goods and services. And no matter what the nominal value is of the US dollar, you're still going to get those goods and services. And that's your protection. If you have, you know, some silver at your house and something happens to our currency, essentially you could take that silver and then exchange it for whatever currency it is, or however much of that currency it is, and then go buy gas for your car to get to work. So I like to leave off there, where, from my perspective, that you're not getting into precious metals to get rich. Sometimes they may overshoot. You're getting into it as a hedge against some downside risk. And it's just like that I was talking about with the wheat farmer and the 100,000 bushels. You may buy a portion of gold or silver to protect against that downside. And you know what, like you said, your Bitcoin could shoot up another 100, 10 times, 100 times in the next 10 years, and you don't need a ton of it if it's going to do that. Right. But you should always have that little bit of downside protection there to mitigate against a possibility of a recession sometime, which could be happening in the next 6 to 12 months.
I always argue with my broker about, I want to be 100% in, 100% in. And he's like, look, if this stuff goes 10x, are you going to miss 10% that we have in cash, or whatever. They go, yeah, it's a good point. Carve off 10% just so that something happens. You'll have you'll have assets to replenish and buy other things with. So, and I look back at 2008, and I was one that was convinced gold and silver were coming back as money back then, and I was wrong. I think they are, but I think I was a decade early, and I was all in, right? And I stayed all in after 2011, and that was a big mistake. Nothing's 100% certain, and this time around, I'm diversifying into other things, including nickel and zinc and
I love some of the battery stuff as well. But what we were talking about earlier with the Maloney wealth cycles, like if you're looking at 2011, I am fascinated right now by ratio charts and stuff. I just saw Patrick Karim put up a chart with a ratio on it. Now I figured out how to do it. And you're going to be seeing all kinds of ratio charts from my writings for a while. But one of the things that I thought was very interesting with that is if you look at gold's relative value to other things, there are times where gold becomes overstretched to other things like lumber or whatever. It might be a proxy for housing, and gold to the Dow ratio. So if you're in a situation where gold is overstretched, like in 2011, if you look at gold to lumber, it's so far overstretched, which basically meant that you might be able to cash in your gold then and buy a house. Because remember, it was right after the housing collapse. So gold was at an all-time high. Houses were at an all-time low. So you don't necessarily stay in gold the whole time. Maybe you take a portion of that gold and you buy it to something that has a better relative value at that time. So part of this is not to be in gold for the rest of your life. But if you're in a risk-off situation, maybe you dial up your gold. If it's a risk-on situation, maybe you dial down your gold a bit and you put it into other things. So I mean, I'm going to have a lot more writings about this down the road. So I can't wait.
I think you're absolutely right to look at ratios. I talk about, the dollar shows up as the denominator in every price right now. And I think that's the wrong denominator because it's inflating away.
Well, you remember that currency.
So you have to look at ratios. Yeah.
Remember the thing with currency I put on that chart there where, you want to value it in the dollar, which is it's a proxy at the moment, but it's a floating proxy. It floats all over the place. But you think about your gold to oil ratio, it's always going to be within like this window. So no matter what the nominal value of it is, take a look on the chart there. Hey, is gold overvalued to oil? Is gold overvalued to silver? Is gold overvalued to certain things? Or is it undervalued? And those are the types of things I think that people should start to at least pay attention to when they look at a risk on or risk off event.
Yeah, definitely. Well, I definitely appreciate the time. We've gone on for a while, so I want to go too long, but
I love it. I love it.
We'll have links to your website in the notes, and Mike Maloney's video series, I think, which you've mentioned a number of times, which I agree are great. And we have those linked on our website. So definitely thank you for coming, Nate.
Thanks for having me, Jim.